is a price area where a lot of buyers will be at because they like that price, and it will hold up as a floor. So the floor is normally under you, so the floor supports you. So it's basically just the floor. Support means floor. And resistance is a price area where a lot of sellers are going to be, when buyers are going to turn into sellers, and this usually stops the price from moving any higher, and that is your ceiling. So you got a floor and a ceiling. Support is the floor, resistance is the ceiling. If we look right here at AXS, Axie Infinity, over the last couple of months, it was kind of going sideways between these two lines, and you can guess what these two lines are. This is the floor, support, and this is resistance. Now, there's a couple of different types of support and resistance. I'm going to go over all three of them, but there's one general rule to keep things simple that you can go by. Now, the first type of support and resistance would be past chart history. So, past chart, back of the chart, what's going on back here? What's the history of the price movements of this coin? So we look back here, and we saw when Axie hit Coinbase, it dropped down to the 65 area, pushed up before it got stopped at the 75 area and sold back off. 65 area held again and again and again, and a fifth time there, or sixth time. So that floor was tested for sturdiness multiple times. That is a support. When buyers see that this floor is holding up, they're going to be willing to come in and buy it higher than the floor. And you see this nice little pop it had. But it still ended up closing back below 75. So the buyers down here turned to sellers up in here, and $75 started acting as support and resistance after this rip when it broke up over it, and the body of this candle closed there. So when it closed over, that floor had to be tested for sturdiness. This old ceiling became a floor. If you live in an apartment building, your ceiling is usually somebody's floor above you. So same thing, your floor would be somebody else's ceiling, and that's how you got to look at it when you're looking at support and resistance. But that floor was not very sturdy. There was a lot of weight, a lot of people selling, and you can see that weight made the price crack through the floor into the person below you's apartment. Went back down a floor. Where did buyers start coming back in close to? The $65 area, and they pushed the price back up because this floor was stable. It was sturdy. It already tested back here, so buyers knew getting it down here right above that price is a good deal. And you see, put the price pushed back above that resistance again, that ceiling at 75. Didn't even get a chance to test the floor. It just dropped right back through it. But why did this start holding up? Why did this price area start holding up? Why did the coin not drop all the way back down to 65 at this point? Well, it started building a new floor. So we run this right across here. Now we could see where that was also acting as some resistance because of the bodies of these candles closing right below this red line. It didn't mean much there, but now that previous ceiling is starting to hold as a new floor. Buyers are pushing it up and making a new sturdy floor. So that floor is very close to that ceiling. So when you bring the ceiling and the wall down, it's going to pop. And you see the buyers coming there pushing it, nice breakout, big breakout over that resistance. So this is your past chart history of support and resistance. You're just going back and looking at the candles. Where was the ceilings and floors that held up very stable, like 65, and the ceiling like at 75? Where are those areas at? We scroll back to the front of the chart and we can see where it had that big sell-off, but look, the floor held up again for a good while until it didn't, and it dropped again and dropped to about $50 before buyers were like, oh, this is a great price. They pushed it back above that floor, but because it dropped below that floor became a ceiling again right here. It had a little trouble getting back above it. It did eventually break, and then it broke through that 75 before making this very nice rip. We knew the 75 area was going to lead to a big break because it had problems these other times getting above it. Every time it got above 75, sellers pushed it back down. But if we didn't know about these candles back here, if we wasn't looking for floors and ceilings back here on the back of the chart, we wouldn't know anything about this 75 area, right? If you're a new trader, you'd be like, oh, why did it just break out huge over 75? That's because it broke to a new level, a new price level above the previous ceiling. Now, the second type of support and resistance is indicator. And some people use VWAP, some people use the EMAs. I don't think you can use VWAP with cryptos. Not yet, at least, or not that I've seen. But in the stock market, people use VWAP. In cryptos and stocks, I like to use these moving averages. This is what this green, blue, and red line are. So these moving averages, they just average out the price over a time period. And the longer the time frame, and this is going to be true with everything in stocks, patterns, support and resistance, anything like that, technical analysis, the longer the time frame, the stronger the time frame. So if you have strong resistance on the daily chart or a 4-year chart, the resistance that's going to be back in the past, the most sturdy support and resistance is going to be the strongest. So for example, if we go into the 5-minute here on Atom, you can see where the price has been up and down and all around these EMAs. Because on a 5-minute, well, actually this is a 3-minute, but either way, they're not that strong of support and resistance. They can break really easily. Well, we go back to that daily chart and we look for some past support. So we just had this big rip. Where's the support at? Well, we got to look for some candles that can connect to it. So we got these two bottoms of these bodies here. We start to draw a line straight across that price at $30. And you can see also where these two candles hit as resistance. So this resistance held up as a new floor right here at $30 before it popped up again. So that is stronger support than what the 10-day, which is this green moving average, would be on the 5-minute chart. So the green is just a 10-day moving average, so it's just the price movements averaged out over 10 days. The blue is 50 days, and the red is 200 days. The 200 day is going to be your strongest of indicators, and that's why you see the price usually stays above the 200 or below the 200, and anytime it crosses to one side or the other of the 200, if it crosses to the downside, it goes bearish and sells off. And when it crosses back over the 200, it goes bullish and has a nice rip. And that's true in every case. So these indicators will act as support and resistance lines too. Third and final type of support and resistance is the one where I'm going to make this super, super simple. So you've got the indicators, you got the past chart history, but if we look real close at these price levels back on Axie, let's look at the numbers these price levels are at. So 65, 75. Where did this run up to? 95. Where did this drop to? 55. And then this drop here, 50. So if you notice, whole numbers or increments of 5 or 10 or 15, 25 cents or dollars, that is going to be what is called natural support and resistance. And this is just a psychological thing that happens in all trading assets, because day traders are looking to move fast, so they got to do the math fast. It's a lot easier to add up if you got 10 Axie and you know it's $60 an Axie. You know that's going to be $600. But off the top of your head, can you do 17 times 53 and figure out what the total cost of your position is? You can't do that math as quick as you can with a whole number or a 5 increment. Without even drawing lines for support and resistance or having these indicators, if you just realize that every quarter movement is going to be a strong support and resistance area. So $1 to $1.25, $1.25 to $1.50, $1.50 to $1.75, and so on. And of course, you'll see areas like $1.35 that might hold a support or resistance, or $1.65 or 165, or just like on Axie, we had 65 and then 55. So if you just keep that in the back of your mind, that every 25 cents or every 5 cents or every 50 cents something that's an easy math to do could hold up as a resistance line. You may see some selling pressure at those price levels, or you may see buying pressure at those price levels if it's trying to hold as support. So you can use all three. Of course, I use all three, but support and resistance is very important to know, and you really need to know it as a trader, whether you're day trading, swing trading, or a long-term trader. So in the first video, we talked about volume and what it was, and we'll recap it here really quick in case you're just joining me. But we're going to talk about how we use volume and support and resistance to plan our entries and exits. So volume is going to be the amount of coins traded in a time period. So if we're on the daily chart here, each one of these candles is a day, and each one of these volume bars is a day, and that measures the amount of transactions, the amount of buys and sells within that time period. So when we're looking for big rips, we're coming up to a resistance line where we've been consolidating sideways for a good bit. You know, this is 3 months of sideways movement out of AXI. If we see increasing buying volume in the buying volume bars, that's a good indicator that buyers are taking over the momentum of the price, and they are more than likely going to push it up. We got a lot more green volume here, a lot more buying volume than we do selling volume. So we have one red candle there, one red volume bar in the middle of this nice little buildup and a big explosion. So you could tell right on this candle that more than likely, once it closed, that this was going to probably pop up because it did not drop even with all that selling pressure. Now looking back here, when we tested the 75 area, we got one little day of buying volume, one little push up, and then a quick explosion, and then we were followed by these 3 red days of selling. And you can see where the volume bars, the amount of transactions, rose up. Now, of course, just because it's all green does not mean that's all buying, and just because it's all red does not mean it's all selling. It's all the transactions. But these bars, when they're green, signify that the buying was heavier than the selling. And when they're red, it signifies the selling was heavier than the buying. So when you have a lot of selling, a lot more selling than buying, you're going to have sell-offs. And when you have a lot more buying volume than selling, you're going to get nice rips. So if we're looking for an entry on AXI here, where would we be looking for? Well, we want to be buying at a support area. We want to buy at a floor, but we want to make sure that's going to be a floor that holds up. So we saw AXI hold back here. Let's say we haven't got in yet. We watched this pop, missed all of this, like dang. And then AXI drops, and we're like, oh, this is going to be our chance. Well, you wouldn't just dive in, jump in right here in this area because we don't know what the support is yet. Right here, you'd have no idea if this is going to continue to dump off or if it's going to come back. It's not till the next day that we see we got some buying that pushed it back above that floor. So you want to look for one more day of confirmation where there's no price movements under the floor. So you got some confirmation there, like, okay, this is going to be fine. So you look for that entry probably on this candle at the bottom around that 66 area, somewhere right above 65. Of course, it pushed up, so you could have made a little profit there, but when you get a big rejection where we didn't have a lot of buying volume come in, we didn't have a lot of selling really, but we had more buying than selling, it just wasn't a whole lot. These are small volume bars, so it was not able to push over that line, so it got rejected. So you could still be holding through here as long as the support is holding, and have your stop loss, you know, somewhere below it. You probably wouldn't want to have it too tight close because you can see this thing is a low supply coin and it gets some wild tails down. So if you got a stop loss in there, if it's not got a little wiggle room, you may get stopped out. That stop loss will save you on this play when it does have this crackdown. So as soon as that floor cracks, you're not going to hold the bag. If you're falling through your floor into your neighbor's apartment downstairs, you're not going to grab your purse and your wallet or your gold out of the safe while you're falling through there. So you get dumped with the bag down to there when that support cracks. So you got to get out there. And when you saw the big buying volume come in, you'd get the breakout and you'd get some nice profits. If you look at the volume bars and the candles, if they're just continuing to go up green, well, you can hold until you see some red and then sell. Or if you just want to lock out profits as soon as you're up in the green, that is absolutely fine too. But don't get it in your head that crypto or any investment is going to go to $1 million or thousands of dollars in a short amount of time. That very rarely happens, even with cryptos. Like, yeah, Bitcoin did run to 50,000 or 65,000 as a high, and it used to be a couple of dollars or whatever, but we're talking over a 10-year something span. So when you're day trading and swing trading, you want to take profits. You don't want to expect everything to go to the moon, because if you continue to hold and it's taking a long time, it is slowly pushing up a little bit, you're wasting a lot of time with your capital that you could be making more money with. You don't want to be sitting, especially as a day trader, in positions for a long time, because if something else starts breaking out big while the crypto you're in is not doing much, you don't have the capital now to go and jump in that other crypto. You'll have to sell out of this one. But the general rule of thumb is, and this is the stock market and crypto saying, buy low, sell high. That is exactly what you're doing as a day trader, swing trader, or long-term investor. If you are going long, you are buying low. You're going to buy on the floor and sell it once it breaks the ceiling, or sell it at the top of the ceiling if it doesn't break. So we buy at support and we sell at resistance. And if you're like me and you look for the bigger breakouts, you want these bigger breakouts, then you're going to definitely have to use the volume to be able to tell when one of these breakouts are coming, so you just don't sell at a resistance line before the big breakout. That's pretty much it for this lesson. If you have any questions, leave them down in the comments below. And if you haven't yet, think about subscribing and joining the Framework Fortune community. Appreciate everybody joining me as always. Stay safe out there. Until next time.